Ladies and gentlemen, good morning and welcome to Deutsche Telekom's headquarters. We would like to inform you today of the performance of our business in 2010. You'll be speaking to Tim Höttges, CFO, and René Obermann, the CEO. And I would like to give the floor to René Obermann. Good morning.
Good morning, ladies and gentlemen. Welcome to our press conference on the 2010 financial year. Last year, like 2009, was a year in which we had to face a range of different challenges in our markets, but we found good solutions to these challenges, in most cases anyway. Overall, we are therefore satisfied with the results. Adjusted EBITDA was in line with our forecast at 19.5 billion euros. Free cash flow at 6.5 billion euros was even substantially above our original guidance. This is a clear indication of our financial strength, and it is important for the dividend which is taken from cash flow. Net revenue of the group increased slightly by 0.4% in 2010 on a like-for-like basis. In other words, excluding T-Mobile UK from the end of the first quarter. This is clearly driven by the development of our strategic growth areas. Overall, we've recorded growth of more than 10% to a total of over 17 billion euros in these areas. Adjusted net profit of 3.4 billion euros is on a par with the prior year figure. Reported net profit totaled 1.7 billion euros, just under 5 times the figure we posted for 2009. Based on these figures and the strong free cash flow, we, together with the Supervisory Board, will be proposing to the shareholders meeting on May the 12th payment of a dividend of 0.70 per share. Together with the share buybacks in 2010 totaling 400 million euros, this is equivalent to total remuneration of 3.4 billion, which is exactly what we announced as part of our shareholder remuneration policy for 2010 through 2012. We are particularly proud of developments in Germany. We have further stabilized revenue and can also report a slight increase in the fourth quarter. Adjusted EBITDA remained stable and the margin increased to 38.3%. In the Europe segment, we've increased our cash flow slightly and improved our EBITDA margin by 1.5 percentage points. And we did so despite difficult overall economic conditions and additional negative factors in several countries, such as the special tax in Hungary levied for the first time in 2010. The positive development of T-Systems has continued apace overall. Revenue from customers outside Deutsche Telekom grew by 5.4%. The adjusted EBIT margin at T-Systems also increased again. We are moving out of the red, and the adjusted EBIT margin increased by more than 1 percentage point to the current level of 3.7%. Revenue from the mobile internet increased by 29.2% to around 4.4 billion euros. And we are confident that this strong trend will continue because we only just started to make the most of the opportunities in the area of the mobile internet. And it is good that we focused our attention on this segment very early on. In the United States, the rollout of our network for high-speed mobile internet and, even more importantly, a wide range of new smartphones are beginning to bear fruit. Even though we are not marketing the iPhone, we have a wide range of Android-based devices, and this is a situation that is bearing fruit, and this is reflected in the sharp increase in mobile data revenue, driven by the approximately 8.2 million smartphones currently on our 4G network. The persistently high churn rate in the contract customer segment means, however, that the overall picture is not quite so rosy, and for that reason revenue development in 2010 is unsatisfactory overall. We have to change this, and we will. I will come back to T-Mobile USA again in a moment. We successfully launched the second phase of our Save for Service program. We intend to generate overall savings of 4.2 billion euros between 2010 and 2012. In the first year, we made gross savings of 2.5 billion euros. A great deal of this money will be reinvested in the rollout of new networks, new products, and new initiatives. But overall, these gross savings already are equivalent to 60% of our target figure. We've directly reinvested a large part of the savings, like I said, to improve our market position in the various operating segments. In total, we've cut our cost base by around 1 billion euros net. The next chart summarizes the development of revenue and earnings on the basis of key figures for the full year. Please bear in mind that the comparison of figures of excluding T-Mobile UK from the end of the first quarter of 2010 is quite important here, because this is the group lineup with which we are starting in 2011, and you can see that revenue increased by 0.4% year-on-year in 2010 on a like-for-like basis, just slightly. This is highlighted once again by a comparison of the fourth quarters of 2009 and 2010 on the next chart, excluding T-Mobile UK. Just waiting for the slide to appear. So you can see the revenue trend excluding T-Mobile UK, and you can see that revenue increased slightly by 0.4%. The earnings figures for the fourth quarter comprise a number of factors that slightly distort the positive development of our operating business. In Poland, for example, we had one-time expenses for the settlement of our long-running legal disputes. This step was, however, necessary from a strategic point of view, because we finally, after years of litigation, agreed on a solution for PTC that will give us full, undisputed ownership of the company at very good terms and conditions, which is why our local management there and our employees can now take PTC forward and develop it unhampered by those legal disputes, for instance with our planned network partnership with Orange Poland, and this will enable us to expand our network not only at much lower cost, but it will also be a high-performance network, and we'll be able to share the burden of costs and bring this network forward. In addition, the regular impairment test resulted in impairment losses of some 0.7 billion euros, which impact profit and loss before taxes as a special factor. And these impairment losses had to be recognized in Greece and Romania. We also recorded special factors in EBITDA of around 0.6 billion euros, the vast majority in Germany relating to our socially conscious staff restructuring measures. Combined, these three factors resulted in a difference of 1.3 billion euros between reported and adjusted net profit. And let us not forget the special tax in Hungary, which has impacted revenue as well as adjusted and unadjusted EBITDA to the tune of some 0.1 billion euros. This tax alone accounts for around 60% of the decline in adjusted EBITDA in the Europe segment. Despite these factors, adjusted EBITDA, as I said earlier, has come in as forecast. And the fact that we also delivered on our free cash flow guidance and that net profit has increased substantially shows just how strong Deutsche Telekom is. We are convinced that this trend is set to continue. What this means for our outlook for 2011 in concrete terms is this. Adjusted EBITDA is expected to remain almost stable at around 19.1 billion euros. This also corresponds to current expectations in the capital market. It should be remembered that there will be no contribution to earnings from T-Mobile UK in 2011. And if you bear this in mind, there is barely any change compared with the previous year. We are expecting free cash flow to remain stable at 6.5 billion euros at the least, or even to grow slightly. This does not include the one-time payment made to settle the PTC issue. This should not be included in your calculations of free cash flow, and the same holds true for any other mergers and acquisitions. A quick look back. When we announced our strategy in March of last year, we forecast free cash flow of 6.2 billion euros for 2010, followed by a slight increase in 2011. So you see, we have substantially increased our forecast in this respect because we now have a different basis that we start from. And that is the basis on which we also intend to implement our shareholder remuneration policy in 2011, payment of total remuneration of 3.4 billion euros with a minimum dividend of 70 euro cents per share and the option of buying back more of our own shares. The focus of our operations in 2011 is on our new approach to the US market, more specifically customer retention in the US. We want to grow again in terms of revenue while maintaining a stable margin. So we want to strike a reasonable balance between our various financial targets. To help improve our results at T-Mobile USA, we have launched another efficiency program called Reinvent, which we expect to generate savings up around $1 billion by 2013. In Germany, we aim to defend our strong market position and stabilize adjusted EBITDA. Despite the massive cuts in mobile termination charges and the resulting pressure on revenue. Our aim for the Europe segment is to stabilize cash flows and to defend our market position in the various countries. T-Systems continues to focus on the ICT services growth market, offering solutions for corporate customers and innovative network solutions. We plan to increase our revenue efficiency further, supported by cost-cutting measures. It goes without saying that we will continue to focus on the mobile internet, triple play products, the combination of mobile communications, internet, IPTV, and value-added services. We will be focusing more strongly on convergence offerings, i.e. a combination of wireless and wireline offerings. We will push innovation, of course, in the field of intelligent network solutions, for instance, in the healthcare area. At the same time, we are aiming to further improve our efficiency. I mentioned earlier our savings target of approximately 4.2 billion euros gross for 2010 through 2012. This includes net savings on balance of some 1.8 billion euros at Telekom Deutschland and in the countries of Southern and Eastern Europe. It is important for us to bring about these savings because conventional fixed network business is still under pressure, and we cannot assume that earnings will improve there, so we have to bring about more savings. Let me now just outline the progress we have made in implementing our Fix, Transform and Innovate strategy. In March, we told you how we aim to develop our business and stated specific measures and targets through 2015. So what have we achieved thus far? Let me give you a couple of important points. In the past year, we resolved two major challenges, basically. We incorporated T-Mobile UK, which had been subcritical in the local market for a long time, into the Everything Everywhere joint venture with Orange, which was launched on the 1st of April. We are already seeing that our maxim of better a 50% stake in the number one than being the sole proprietor of the number four in the market was the right way to go. Everything Everywhere has paid us a dividend of 380 million euros from free cash flow, and operationally the joint venture has helped us acquire some 300,000 new contract customers in the fourth quarter, and this after a relatively short period of time. bear in mind that this sort of joint venture always includes a certain degree of uncertainty for those involved, and therefore 300,000 new contract customers is quite an impressive result. I already briefly mentioned PTC. In 2010, the company increased revenue on a euro basis by just under 5% and improved its EBITDA margin by 2.5 percentage points. Year on year, the number of contract customers increased by 140,000. So here, the situation as regards PTC is quite favorable as well. Our mobile communications companies in Austria and the Netherlands have also improved their margins. In the Europe segment overall, the number of contract customers increased by some 1.1 million. In the United States, monthly data revenue per user increased sharply again in the fourth quarter by 25.5% to $12.80. Would be nice to see the same figures in Europe. However, the Americans are even faster than the Europeans in this segment, but maybe will be possible for us to get there as well. So $12.80, that is quite impressive, and it shows that it is worthwhile for us to move ahead with mobile internet. In 2010, we completed the integration of fixed network and mobile communications activities in Germany, Slovakia, and Croatia with our integrated companies. This integration of fixed network and mobile communications has delivered additional results in Germany. We've just launched the integrated wireless product Call and Surf via Funk, implementing our broadband products via LTE and carrying voice traffic over the fixed network. We are continuing to build the networks and processes for the gigabit society. In Germany, that means further expanding the 3G network and rapid rollout of an LTE infrastructure. LTE has helped us close several hundred gaps in coverage, and our wireless Call and Surf Comfort via Funk product means that many areas that had to do without DSL in the past will get high-speed internet access. And we are also pushing forward with rolling out optical fiber. We are demonstrating quite clearly that we want to offer broadband for more customer groups and expand the possibilities for use with high bandwidth. Let me say a few words about our network strategy. On Monday, we will hold a press talk and we will be dealing with this subject in depth there. Our colleague, Mr. Van Damme, will give you all the details at this meeting. One striking example of connected life across all screens is the sharp increase in the proportion of smartphones and the total number of cell phones sold. And this also holds true for tablets. In Europe, the number of smartphones sold increased last year by 57% and now stands at around 4 million. Handsets running the Android operating system accounted for over 25% of total sales in the fourth quarter, and this trend is set to continue. We can offer smartphones in a range of price categories and with different operating systems. In Eastern Europe, it is pivotal, for instance, that we have different operating systems, that we do not only have devices in the high-end range, and this supports our strategy of making the mobile internet affordable. T-Systems has launched innovative products for connected life, such as infrastructure as a service. At the same time, pilot projects for smart metering and e-health have been set up to promote business with innovative network solutions. And T-Systems once again landed a number of big deals in 2010. We have defined 5 growth areas as part of our strategy and set out specific revenue targets for each of them. With the results achieved last year, we are well on track to achieving our targets for 2015. I've already touched on some topics such as the growth in revenue from the mobile internet of 29.2%, which corresponds to 1 billion euros to around 4.4 billion euros. Growth has once again sped up in this sector compared with the first 9 months, when we are looking at an increase of 26%. As I said before, we have only just begun to leverage this segment. All the progress made by T-Systems in business with customers outside the group, this should also be mentioned, because intra-group revenue for T-Systems is declining. However, T-Systems more than compensates that by way of growing its business with customers outside of the group. We are seeing solid growth in revenue with double and triple play products for the connected home and with new products such as Home Gateway and Communication Suite. Here, growth has been in the order of 5% to 5.5 billion euros. Our internet products contributed around 1 billion euros to revenue in 2010, a 13.1% year-on-year increase. We are currently not generating significant revenues from intelligent network solutions, and we did not promise we would. That said, we have set up a host of promising projects, and we've promised that we intend to save about 1 billion euros, and I think that is realistic. Looking at the products we've got, considering the feedback that we've received from customers and from healthcare insurance companies, the feedback that we've received from doctors and hospitals, there's a great deal of interest out there in the market. So this whole healthcare sector and the energy sector as well, these are two areas that make me very confident. And media distribution will be an important subject at CeBIT. Let's wait and see what's in store there. So we've got an interesting range of products and partnerships in store, and just got the first major deal in the smart metering area. So it's all very promising. Before I hand over to Tim Höttges, who will, as usual, provide the details on the developments in the operating segments, I would like to tell you a bit more about our strategy for T-Mobile US. Philip Hum and I presented it to you at the end of January. We've set ourselves a clear goal. We want to increase revenues together with a stable margin before the end of 2011. Undoubtedly, certain challenges still lie ahead, but on the other hand, we are seeing a host of very positive factors that make us confident. What's positive, for instance, is that service revenues are starting to stabilize and remained at the prior year level in the fourth quarter. The strong growth in data revenues played a major part in keeping the monthly revenue per user stable at $46. Business with terminal equipment insurance, which T-Mobile USA, like its competitors, has now been offering directly since the fourth quarter of 2010, had a positive impact on revenue. Adjusted EBITDA came in virtually stable year on year, just as the margin did. This was thanks to lower costs for new customer acquisition and the retention of existing customers in the fourth quarter. At the same time, the matter of customer acquisition and retention poses one of the biggest challenges. The churn rate among contract customers is too high at the moment, and we are aiming to rectify the situation before the end of this year. The trend is reflected in the number of net adds last year and in the fourth quarter. Over the past 3 months of this year, we have lost a net total of 318,000 contract customers. We not only have to expand our customer base. Acquiring a new mobile customer costs considerably more than retaining an existing one. So reducing churn clearly contributes to improving earnings. We gained almost 300,000 net customers in the prepaid segment, also because we've expanded our alliances with mobile providers that do not have their own network. An important selling point in competition in the US is the combination of a broad range of smartphones, in particular reasonably priced devices, with affordable rates and our well-developed and fast network. And this is what our customers believe in. Obviously, some things cannot improve overnight. It takes long-term communication to regain customer confidence. T-Mobile US has continued to expand its 4G network with transmission speeds of up to 21 megabits per second, which now reaches 200 million people in 100 major cities in the United States. We have the largest 4G network, and it is the fastest network, mind you, in the US. The next stage is to increase transmission speed to 42 megabits per second. By mid-2011, we will therefore be able to offer services to some 140 million people. So we do not only intend to boost wireless transmission speeds, HSDPA for instance, but we also need to roll out our optical fiber network. Only then will we be able to improve user experience in terms of transmission speeds. We have set clear targets for T-Mobile US for 2011 and beyond. We want to increase our revenue again while maintaining a stable margin. The Grow and Reinvent programs are therefore central to the work of the team built around Philipp Hum. The Grow program envisages revenue growth of $3 billion through 2014. We aim to benefit even more from market growth, particularly with the mobile internet. At the same time, Reinvent is intended to generate gross savings of $1 billion through 2013, which will improve earnings further. Finally, the churn rate among contract customers is to be reduced toward the 2% mark in 2011, compared with 2.3% for the whole of 2010. So there's still a long way to go, and we are still far from achieving this goal. And with that, I would now like to hand you over to Tim Höttges, who will take you through developments in our business in Germany.
Good morning, everyone. I'll speak about the Germany division and specifically look at the financial results of that part of the business. Revenues and adjusted EBITDA grew in Q4, and EBITDA in particular was supported by a 1.7% reduction in adjusted OPEX. That's operating expenditure. Accordingly, the margin improved by 0.3 percentage points year on year to just under 37% in Q4, which is a continuation of the very positive trend of the past 2 quarters. Let's turn to the details, starting with fixed. As already suggested in Q3, revenue trends in the fourth quarter have significantly improved. The resulting year-over-year revenue decline of 3% for the full year is a further improvement over the prior year. And this shows that we are well on our way towards stabilizing the Germany revenues as a whole by 2012. Adjusted EBITDA increased by 1.1% to almost 1.5 billion euros in Q4, despite the, as usually, higher fourth quarter commercial efforts driven by adjusted OPEX savings of 3.8%. Our broadband net add share in Q4 was impacted by very aggressive unbundlers who gained market share at the expense of cable. The resulting market share in Q4 is 30.1%, which of course we're not happy with, but overall we remain very competitive. The DSL market is declining overall, but our broadband market share of 46% was defended. We have a significant reduction in line losses, which were at around 20% over the last 2 years, and in 2010 the figure dropped to below 1.6 million in 2010. This is the lowest they have been for 5 years. With our double play price cut in Q4 and a simultaneous increase in standard download speeds to up to 16 megabits per second, we have improved our competitiveness in the marketplace. Importantly, we had solid IPT growth and sold more than 500,000 additional Entertain packages. The Entertain customer base at the close of the year was almost 1.6 million packages. We had originally aimed for 1.5 million. And by the end of the year, 1.2 million of these had already been connected. In the German mobile business, we continued our market outperformance despite the impact of the mobile termination rate cuts. Excluding the impact of those cuts, service revenues went up 5% year-on-year in Q4. This solid growth in service revenues was driven by data revenue growth of 28%. And we have again increased our lead in terms of service revenues year-on-year. Despite the fact that we are no longer the exclusive retailer of the iPhone, we continued our very strong iPhone sales with almost 350,000 iPhones sold in Q4 alone. In addition, we sold almost 50,000 Windows 7 smartphones. Also adjusted for the impact of the MTR cuts, adjusted EBITDA went up by 1.1% to more than 900 million euros. We had an adjusted EBITDA margin of 41.7%, and that put us ahead of all of our competitors. Turning to Europe, despite a difficult macroeconomic environment, our impressive growth in strategic products continued. The number of TV customers grew by almost a quarter to 2.4 million, and this is of essential importance for customer retention and for ARPU stabilization in all of our businesses. It is also an integral part of our connected life across all screens strategy. At the same time, the smartphone share more than doubled to 34% of new retained customers in Q4, which lays the foundation for even more mobile data revenue growth. Also, in 2010, the number of broadband customers grew 12% to 4.6 million. The number of mobile contract customers increased by over 1 million, or 4%, to now over 26 million. Financially, we have been very disciplined with our investments, and we were able, despite the EBITDA decline, to keep the cash contribution from the Europe segment almost stable, in spite of the new special tax that we had to pay in Hungary, which I will speak about more in just a moment. Let's take a closer look at financial developments in the integrated operations in the Europe segment. The OTE Group maintained a relatively stable margin of 34% in Q4, despite continuing revenue pressure. In Greece, we gained traction in broadband net adds thanks to new tariffs, and in fact, we also saw that IPT customers more than tripled to 50,000. We're pleased with the continued strong performance of our operations in Croatia, and the margin there has improved to 41%. The number of IPTV customers went up 26% year-on-year to 297,000. The performance of the Magyar Telekom Group was, of course, severely impacted by the special tax on revenue in Hungary, which impacted both revenue and adjusted EBITDA to the tune of 90 million euros in Q4. Excluding this tax, adjusted EBITDA would have been essentially stable year-on-year, and the margin would have increased to 38%. Operationally, the number of TV customers went up 19% year-on-year to reach 750,000. Thanks to our investments in a better network and a smartphone drive, we have managed to perform better than our competitors in the Hungarian market. Slovakia saw revenue and adjusted EBITDA developments that were similar to the previous quarters. We were able to compensate the decline in mobile revenues partially by growing in fixed network. Turning to the mobile-centric assets, developments varied from market to market. In Poland, we had a very good year. Revenue there went up 5%, and our EBITDA margin went up by 2.4 percentage points to now 38%. We also acquired 140,000 new contract customers, which has improved the quality of our customer base. In the Q4, we were able to settle our long-standing dispute concerning PTC ownership. We appointed a new CEO, and we have signed a letter of intent with Orange Poland on network sharing. So we have created the basis for a continued improvement of our strategic position in the Poland market, and we now aim in the medium term to become market leader in Poland. In the Netherlands, we're seeing that the integration with Orange or the integration of Orange is bearing fruit. The savings targets we communicated at our Investor Day have been largely reached. Our adjusted EBITDA margin went up by more than 2 percentage points. In 2010, in terms of service revenue and contract customer growth, we clearly outperformed our competitors. Mobile data continued to grow extremely strongly at 40% in 2010. In the Czech Republic, our 48% margin was defended. At the same time, our contract customer base went up by 4 percentage points, and our churn rate was very low at 0.5%. We have invested a lot in our network there, and the number of 3G base stations almost doubled over 2009. Together with the integration of our fixed network activities there, we will be in a much better position to offer more convergent products and services. In Austria, revenue was very strongly impacted by regulation, but we were still able to defend our market share in terms of service revenue, where market share is currently at 30%. We were the only operator, or the first operator, to offer LTE services and offer mobile TV in November. In the fourth quarter, we saw the lowest churn rate among contract customers to date at 0.8%, and our iPhone sales went up by 12% year-on-year, despite the launch of iPhone by Telekom Austria. In connection with the Europe segment, I'd like to give you a quick update on the OTE synergies. In Q4, we had already implemented measures with an annual potential of 250 million euros. The total run rate from the acquisition case has hence been achieved 2 years earlier than we had planned. Savings are split into 60% CapEx and 40% OpEx savings. Turning to the systems business, T-Systems revenue growth continued in Q4, where revenues went up 3.8% and external revenues went up by 6%. At the same time, System Solutions continued to improve profitability driven by efficiency. Adjusted EBIT, or the adjusted EBIT margin, went up from 2.6% in 2009 to 3.7% in 2010, while adjusted EBITDA went up 2.7% to 948 million euros, which is a margin of 10.5%. This reflects the very effective execution of our efficiency program with a Save for Service contribution of 0.6 billion euros in the 2010 financial year. After this overview of the divisions, I'd like to turn to free cash flow for the group. At 6.5 billion euros, we overachieved our original guidance by 5%. This is a very impressive result, and it highlights the success of our centralized free cash flow management and the fact that we have very efficient procurement structures here at Deutsche Telekom. As for working capital management, we achieved a significant improvement in our payables. Our cash capex was reduced by 650 million euros year-on-year to 8.6 billion euros excluding spectrum. So we've demonstrated capex discipline without, of course, jeopardizing the necessary investments we had to make in infrastructure. Turning to our cost-cutting program, Save for Service, we achieved gross savings of 2.4 billion euros at group level, or almost 60% of the total targeted 4.2 billion for 2010 to 2012. Strong savings contributions are currently coming from all segments and all regions. For the group, this resulted in a net cost base reduction of 1 billion euros. Strong underlying net savings in Germany and in Europe were partially offset by reinvest predominantly in the United States. As we announced at our Investor Day last year, I would like to update you on what we are doing at Deutsche Telekom with regard to return on capital employed and the development of that indicator. Having introduced ROCE as our key steering logic last year, we are now working on a number of key measures to drive ROCE improvement. I'll give you a couple of examples of what we're doing there now. We have started to introduce a management incentivization system, including line management with ROCE, and we have started to reduce the OPEX base through our Save for Service program. This has become part of our corporate culture, and this will remain a core focus going forward. Central free cash flow management, including an optimization of our working capital, will be an important issue in the next years to come. More proactive portfolio management, including the fixing of our underperforming assets, as proven by our UK joint venture, are on the agenda. The measures that we're doing in order to improve performance in the US are part of this venture. And finally, we have proven that we are continuing our discipline with regard to mergers and acquisitions. That, again, has helped and will help to improve return on capital employed. Let me be very clear. We're not happy with the development of the return on capital employed in 2010, even though underlying ROCE slightly improved to 4.5%. Personnel restructuring measures, as well as the impact of the establishment of our UK joint venture and the settlement of the situation in Poland, weighed on the ROCE. This has resulted in a reported ROCE of 3.5%. But all three of these factors were very conscious management decisions to improve the situation of the company and achieve longer-term ROCE improvements. Of course, they impacted in the short term on our ROCE in 2010. So, despite all these developments with ROCE, ups and downs, we remain committed to improving that indicator at Deutsche Telekom over the next few years. Let me conclude by reviewing our balance sheet. Our key balance sheet indicators are still solid, and they are well within our comfort zone. Compared to a year ago, the ratio of net debt to adjusted EBITDA increased to 2.2, but it is down from its peak of 2.3 times as of Q2. Gearing remains stable with a factor of 1, while the equity ratio actually improved by almost 1 percentage point to 33.7%. Our credit ratings remain stable, and all ratings agencies have given us a stable outlook. And with this, I would like to close, and we now look forward to taking your questions.
Right, the first question from Dr. Koch. Mr. Obermann, how much are you losing as a result of the cuts in termination charges? And the second question is this. With regard to the UK, you said it is better to hold a 50% stake in the number one than being the sole owner of the number 4 in the market. Why are things different in the US? Are the options different, or?
Well, to start with the second part of your question, Dr. Koch, we have been looking at what partnership options there were in US, and that included network sharing, national roaming network partnerships, and so on. We are essentially open to partnerships in the United States. But the complexity of these partnerships is much, much higher than it would be if we were in Europe, in a European country, because the market situation there is different. It's far more consolidated. There's far fewer potential partners in the United States. So the solutions that are conceivable are, of course, being looked at. We're working through them one by one, and we'll be giving you an update on that in the few months' time. As for the impact of the mobile termination cuts, comparing like for like, we'd be looking at an impact of between 250 and 300 million euros. That would be the impact of the MTU cuts.
Dann war Frau Luven die nächste, Herr Brösch.
Next questions? Good morning. I have 3 questions. First of all, can you give us a number as regards the settlement reached for PTC? Secondly, how do you explain that the churn rate in the US continues to be so high, even though you say your network in the US is one of the best networks available? And thirdly, why isn't it your goal to improve the margin in the US? Because this is pretty much below the group average. So why do you want to boost revenue but keep the margin only stable? Let me start with the last question. The economies of scale are crucial when it comes to improving long-term yield. Our market share today is fairly low and the churn rate is too high, which is why our top priority is to stop this negative trend, and ultimately this will also help us boost both revenues and improve the margin. And why does it take so long for the market to stabilize? Well, this churn rate is attributable to various factors. One example is the network image and the trust customers place in the T-Mobile network. As we only launched the 3G network fairly late, we lost consumer confidence and we have to regain that confidence. However, you can't improve a company's image within a matter of several months. It sometimes takes much longer, as we've seen in other markets. Would you like to comment on the PTC question? Yes, I'll be happy to. Well, PTC was a lengthy story. It was an 11-year litigation at all sorts of places of jurisdiction, and it had a major impact on operational business. And obviously, all parties involved had to pay a lot in attorney fees, probably, millions of euros in the double-digit range. But this is all water under the bridge. We are now looking ahead towards the future. Deutsche Telekom now is the sole owner of PTC. This is also entered in the commercial register. We have reshuffled the local management, and there are no legal disputes left in connection with PTC. In January of this year, we paid 1.4 billion euros in cash, and settlement costs were not rated as acquisition costs. They amounted to 400 million euros, but this was included in the total cash out of 1.4 billion. Part of that was acquisition costs, but only part of it. I would like to add something to this. We just talked about network image, and this also makes people leave T-Mobile US. Another reason is that we've not been able to sell the iPhone in the US. That caused some trouble. We've lost a lot of customers who wanted to have the iPhone. They weren't dissatisfied with the T-Mobile brand at all. They just wanted to have the iPhone, and we couldn't give it to them. Next is the following. How can I put this? Well, other providers had a different customer structure. During the economic crisis, our churn rate was also boosted on the back of other factors. Well, can I get back to the issue of the margin, please? Basically, you've sent Mr. Hum to the US saying that he knows how to cut costs, and there's still a great deal of room for cutting costs. Don't you think that this should speed up an improvement in the margin? Well, it's not quite as easy as that. I was saying that Mr. Hum has a great deal of experience in various fields, including cost cutting, but also with regard to growth initiatives. He's been very successful at driving growth initiatives in Germany. And Mr. Hum is very much focused on the market itself. His goal is to stabilize the market, to boost growth, and to then improve the margins in the long run. However, without revenue, without customers, there's no way you can improve the margin. I would like to add one more sentence to this. We've set up a new cost-cutting scheme in the US with a volume of 1 billion euros. And I think it would be premature to, expect the situation to improve within a matter of 6 weeks. All right, let's continue with the next questions.
I have 2 or 3 questions. Mr. Obermann, I didn't quite understand what you said about the United States. The 318,000 contract customers that left you in Q4 surely were well aware of T-Mobile's superior network, and surely they also bought the iPhone to some extent, so I didn't really understand what you were saying. And as for the margin, you're saying that you want to stabilize your customer base, and surely 1 or 2 percentage points in margin shouldn't make that much of a difference. Secondly, I need to hear a little bit more about how you want to maintain your outlook, that is to stabilize the situation. That in Germany, MTUs have gone down by half. In the United States, it doesn't look as if you're going to be taking off like a rocket in 2011. And we're seeing that the economic situation is impacting on Q4 figures, which is probably also indicative of this year. So could you maybe say something about how you want to improve things? You have already indicated you want to instigate savings. And here's my next question. Telekom Serbia is probably not interesting to you because of the situation, or are you maybe interested? And if so, how much would you be prepared to pay for it? Then cooperation with France Telecom. You're cooperating with them already in several areas. Are you intending to expand your cooperation with them? Are there maybe some larger plans there? I will try and respond to as many questions as I can and pass on your other question to Tim Höttges. You first referred to network image and reputation. I tried to be a little more detail there because there are several reasons for our churn rates. By the way, other providers have already seen some very similar phenomena in the past. It's not just network reputation, it's also network coverage that is a factor, especially in the metropolitan areas. The range of terminal devices that an operator offers is also important. But of course now with Android we now have a wider range of attractive devices, and thankfully they have now even overtaken the iPhone in terms of market share, which is helping us. I also mentioned the people who won't be paying their bills during the crisis. During the crisis there were several private insolvencies, people who really encountered personal financial difficulties, and they went from contract to prepay. So that is also something that impacted on the churn rate. So there's a variety of factors that played in there. And as I said, we're working on improving the matter. And I think it's important to be able to recognize where these changes have come from, and so that we can find ways to eliminate the problems. I'm sure our team out there will be successful. I didn't quite understand your question about the margin. I never said that the margin wasn't important. I said that the margin in the fourth quarter was decent, and that we want to continue stabilizing the margin in 2011. And I will tell you again, it's not about increasing the margin by 1 or 2 percentage points. What we need to do is to stabilize our customer base. We need to continue growing and continue lowering the churn rate. That's important because in our industry, economies of scale are very important, and once that's done, the margin will go up. As for Telekom Serbia, I wouldn't want to speculate at this point. And as for the cooperation with France Telecom, it's following industry logic, what we're doing there. There are many areas where even several European national operators aren't big enough in order to make things move. You need to work together with your competitors in many cases to standardize things. Wi-Fi roaming is a case in point. There are several Wi-Fi hotspots that we have internationally, and we have decided to work together with our French partner in order to make it easier for our customers to roam. You know how expensive it can be when you go abroad, and this cooperation will help us to set ourselves apart from the competition and give our customers a better international experience. Anything else is pure speculation. As for the guidance, which is quite precise at 19.1, I should say first that when we manage our indicators, we discipline ourselves and make very sure that we can deliver on our promises. If you look at our original promise of 6.5% increase EBITDA, we're now at 3.9%. We have gone up continually in terms of EBITDA and EBITDA margin. The second thing is safer service. In the first phase, we promised 5.9, which we over-delivered on. In the second phase, we're looking at 4.2 billion, and in the first year already, we managed to achieve 60% of that. And the third thing is the turnaround in Germany, where we said EBITDA in Germany will have stabilized within 3 years, which we delivered on. And we have now indicated, or we did indicate at our investor day, that we will increase our free cash flow. Our guidance is according to that, and that we're going to stabilize our EBITDA. And on the basis of these commitments, these promises that we have made externally, we are now executing our programs. Now, where do these 19.1 billion come from? Of course, we're now not banking on the UK anymore. And when we compare 2011 and 2010, we need to look at the business excluding the UK. And at 19.1, we are at the same level of EBITDA in 2010, excluding the UK. Okay, how do we want to deliver on that? We assume that the German business will stabilize or even grow, despite mobile termination cuts. We assume that we can compensate for that effect on the cost side. In fact, we have to. In the United States, we assume that we are on a growth track both at the top line and at the bottom line. Thirdly, we're seeing that our European market is stabilizing, especially in Eastern Europe. If you look at the overall economic situation in Poland, for instance, or in Hungary, you're seeing that the environment is very much improving. Consumer behavior is being boosted. Romania and Greece are, of course, a bit of a headache in Eastern Europe, but all of the other countries are looking up. Fourth, our Save for Service program has been stepped up, and in the second year of the second phase as well, we want to step up our efforts in order to improve our cost base and in turn improve our margins. And 5, we are not speculating on certain exchange rates. We assume that the dollar to euro translation rate will remain largely the same as in 2010, and that there will be no impact on our guidance for this year. As for free cash flow, we assume that free cash flow will go up and basically reach a level that is already higher than in 2010. In 2010, we were aiming for 6.2. We delivered 6.5. And starting from that higher level, we assume that we're going to grow again. So this company is now on an upward trend. Our EBITDA and our free cash flow is assumed to increase. At 11:15, Mr. Obermann will have to go live before the TV cameras, and I have 7 questions on my list, so please be as brief as you can. Let's take your questions one by one. Question 1. How many smartphones are you selling in terms of market share? What's the percentage figure? And you also mentioned ROCE of 3.9%. I assume that you're paying more for outside capital. And if that's the case, shouldn't that mean that your equity is actually reducing, shrinking, and would that not impact on your stock price? I think we're now selling 60% of all smartphones. Were you referring to Germany or worldwide? In Germany, we're selling more than 50% of all our smartphones. We're somewhere between 50 and 60. Worldwide, or in Eastern Europe, at least that share is lower, but it's been growing faster. We are accounting for a rising number of smartphone sales. Of course, it's important how many tablets you're selling. Tablets are achieving the same kind of data volumes as PCs. Our return on capital employed is also to be seen in relation to our weighted average cost of capital. And it should be the same for equity and for outside capital. We have a BBB+ rating now, and the last bonds that we issued are around 4.2, 4.3% for a 5-year bond, or a 5-year bond that we have issued. The risk capital of our investors is, of course, higher than that. Deutsche Telekom today is not earning back its cost of capital, not at the moment. So we need to become more efficient in terms of the way we use our capital. That has a lot to do with the 120 billion in capital that is tied up on the capital employed side. And it's to do with the operating income performance of the company on the other side. And we are very glad to have introduced ROCE as an indicator, because it doesn't just look at adjusted figures, adjusted values that only give you a snapshot of what a company is doing. It actually takes into account all indicators in the company, including special factors. As we saw on the slide, they also play a big role, which includes the cost of restructuring the workforce, the cost of settlements, the costs that we have in connection with impairments. All of these factors play into our ROCE. And our aim of achieving 150 basis points by 2015 is part of course, our Board of Management targets, but also part of the targets of the second management level here at Deutsche Telekom.
I have 2 questions. First of all, now the antitrust authority basically introduced legal proceedings as a result of an illegal alliance in the 4th quarter. Are you assuming that the allegations raised do not make sense at all? And why is there no mentioning of this matter in the annual report? Secondly, in the past year, you always said, gave us a figure of more than 46 as regards net adds in broadband business, and I didn't find an up-to-date figure in the current annual report. Do you expect to be able to maintain your current market share in the area of net adds and broadband? Well, first of all, the antitrust authority. I am not aware of any ongoing proceedings. Maybe you know more than I do in this respect. Secondly, net adds in the broadband segment, 45% or more. Our goal is to maintain our current market share just about, but it's not easy at all because the cable operators are very strong in the market, and alternative network operators have come up with very aggressive pricing, 15 euros, for instance, for a monthly package. And these are not the sort of prices that we can offer. So we need to continue pursuing a premium price strategy, meaning that we provide a better user experience in order to justify why our prices are higher than those of our competitors. And that doesn't make our life easier at all, which is why our goal for now is to maintain our market share. And I think we are adequately realistic to know that the situation is likely to become even more difficult in the future. Just for information, the proceedings have been instigated. All right, so you know more than we do about that. And we'll certainly hear more about that. As always, we will be happy to cooperate, and I'm quite confident that we will be able to deal with any possible allegations raised. Let's continue with the next questions. Mr. Obermann, I have two questions. What is your strategy to counteract the cable operators' success in the market? One of the buzzwords here is the rollout of the optical fiber network. You've set yourselves some ambitious goals. Can you confirm these goals, and will you be able to keep pace with your competitors? Secondly, US business. Can you roll out that T-Mobile USA will go public? Well, the second thing you mentioned is just speculations, and that's what it is, just speculations. As far as the cable operators are concerned, well, we currently have a large VDSL network, but I think we also need optical fiber to the home. We've got 11 million households connected to the VDSL network, so we have to continue rolling out the optical fiber network. We also want to hook up rural areas, and we need adequate services, IPTV, internet connectivity, and then value-added services such as storage services and the like. We need to come up with all sorts of attractive offerings to counteract cable operators, and I think we can do that in terms of the right products and also on a local basis, which is why I do believe that we will be able to keep pace with our competitors, but we have to continue upgrading our network. We have to step up marketing our VDSL network, have to combine or have to focus more strongly on combined offerings, i.e. fixed network and mobile communications, to make sure we are not lagging behind the cable operators in the market, and that's our goal. Next question, please. Will the dividend to be paid this year be tax deductible again? And you said that payment will be 0.70. And maybe you can also tell us something about the current wage talks. Well, Mr. Höttges will say a few words about the dividend. Let me comment on the wage talks first. Currently, there is a big discrepancy between what the employee representatives want and what we as an employer can offer. But what we offer is more than just a 2% rise. We offer a package of further training, for instance, improving our employees' skills, helping employees to move towards new areas such as internet technology. That's an important element. We also offer more opportunities in connection with early retirement. We continue to have a very high training ratio. So you really need to take a look at the overall picture. And I think the employee representatives should not only focus on the actual pay rise, because if we were to do that, then this wouldn't help us improve labor relations in the long run. We need to take account of all the other measures as well. Let me say a few words about the dividend. The dividend yield, well, 0.70 is about 7%. It is tax deductible, or tax-free rather, and therefore it is very attractive compared with the dividends paid by other companies. Looking at the success of our 3U shareholder remuneration strategy, we can be very satisfied. Compared with other European telecoms, we come in third as far as the combination of the dividend on the one hand and the share price on the other is concerned, which is why we believe 0.70 plus the 400 million euros as part of share buybacks are quite a positive result and will meet with expectations. Question is the dividend covered by actual net profit? Well, first of all, the single entity financial statements have to be used as a KPI here. This is what you have to take as a basis for calculating the ratio. Having said that, I think it is not right to look at an IFRS financial statement based on German GAAP. According to IFRS, it is more decisive whether cash flow generated by the company covers the amount actually paid. 6.5 billion and now a payment of 3 billion certainly show that this is the case. And therefore, it is much better to look at things in this way rather than focusing on German GAAP and looking at the IFRS results against the backdrop of German GAAP. That doesn't make sense. Well, back to the issue of legal proceedings. Apparently, these are just administrative proceedings. And apparently, it only began this year, which is why this was not an issue in the 2010 financial report. Now, please bear with us. We are going to have a live interview at 11:15, which is why we can't take any more questions. But obviously, Mr. Obermann will be available to you after the conference as well. Thanks for coming. Thanks for listening. Wish you a very